Hello, I'm Kimberley Dondo, Digital Content Manager, and welcome to In Conversation With, the podcast series that delves into the world of financial services and brings you face to face with some of the most notable figures in the industry. Listen as we discuss topics that are currently facing the industry and hear from visionary CEOs to disruptive innovators as we bring you a diverse array of voices and perspectives. We'll explore the challenges they faced, the lessons they've learned, and the insights they have to share about the ever-evolving landscape of financial services. Hello and welcome to In Conversation With. I'm Kimberley Dondo, and in today's episode, I'm joined by William Marshall, CIO and Head of Wealth Investment at Hymans Robertson Investment Services. Thank you for joining me today, William.
Hi, Kimberley. Nice to see you.
So before we kind of get started into the main part of our podcast today, could you give us a bit of a background into yourself and how you got started in financial services?
Yeah, certainly. So I've worked in financial services for about 25, 26 years now, and it was always an interest of mine to work in financial services. So once I graduated from university, I worked at a couple of sort of the main sort of insurance companies in Scotland, so Standard Life and Scottish Amicable in particular. But it's probably more the big things when I joined Hymans in January 2003, which I still find scary because it's like over 21 years ago now. It doesn't feel that long, but it's nice as well. So it's when I joined Hymans and over 20 years ago really was when I got really fully involved on the institutional and gradually the retail side of investing. And it's that obviously where we are today. Mm-hmm. Having worked with some of the largest sort of institutional funds, pension investors in the country through my time at Hymans.
Yeah. And in today's episode, we're going to be talking about retirement planning and also the consumer duty. But I wanted to start by asking if you could share any instance from your experience where sequencing risk significantly impacted a client's retirement journey, and also how Hymans Robertson equips advisors to proactively address that risk in client portfolios.
Yeah, absolutely. So just as a reminder, sequencing risk, it relates to the risk that your investment returns happen in the wrong order at the wrong time. And it's most commonly associated with retirement. So when people are withdrawing money from their pot and ultimately getting really bad returns just when they've started doing that. So when the pot's at its biggest, that's the most commonly thought of as what is the main source of sequencing risk. However, it shouldn't just be viewed as a post-retirement feature. If you get adverse outcomes as you approach retirement, so even before you're taking money out, that can significantly impact your ability to retire and maybe impact the sort of size of tax-free cash you can take as well. Indeed, there was an Australian research paper I was reading, and they were suggesting that sequencing risk actually is at its greatest about 10 years before retirement and 10 years after retirement. And it's just highlighting that need for greater certainty of returns as you approach and as in the early years of retirement is really what you want. And kind of, again, prime examples of when it sort of happened really is obviously, again, just prime examples maybe a bit of technology bubble and the financial crisis, just when people maybe thought they were approaching retirement, this big market sell, but it takes a long time for that to recover. Mm-hmm. And in terms of how we help advisors, it's probably worth just a bit of background on Hymans. So we've predominantly been an institutional, working with some of the largest institutional investors in the country, but about 5 or 6 years ago, we moved into the retail market and we manage model portfolios we're DFM and model portfolios for advisors. And it's been using a lot of those institutional learnings and experience that we've sought to bring into the retail market. So helping managing sequence risk, a prime example of where we've used our institutional knowledge and tooling to help do that. And so some of the examples is we look to build portfolios that are robust across a range of market conditions. So the way we do that, each portfolio is scenario tested against 5,000 economic scenarios and do that using our own in-house model. It's the same model we use here as we use for our large institutional investors. We make sure every portfolio is well diversified, both between asset classes but also within asset classes. It's a really big thing for us there. And also, although our portfolios are growth focused, we do like to make sure they've got a nice income generation taken on within the portfolio. So they've got that nice income underpin that helps preserve value at times of market volatility as well. And actually, we did a piece of work recently that was suggesting that because of diversification and scenario analysis, that HRIS portfolios could generate about an extra sustainable withdrawal rate, about 50 bips per annum over the long term relative to a passive type multi-asset fund.
Mm-hmm. And talking about longevity, let's debunk some common longevity myths. So what are some of the most persistent misconceptions advisors encounter, and how can they guide their clients towards a realistic retirement plan that accounts for longer lifespans?
Yeah, longevity is obviously, talking about death is never the most exciting subject to talk about, but it's real life.
No one really knows that. I mean, the oldest woman in the world just recently passed away, and she was 117. I'm sure she didn't plan for
exactly. that. So there is, as you say, Kimberley, there's lots of misconceptions, and one of the main ones is that people are absolutely terrible at projecting their own life expectancy. We did a bit of work, our sister company Hymans did a bit of work, and they found that males typically underestimated their life expectancy by about 3.5 years, and females typically underestimated their life expectancy by about 8 years. So quite a considerable amount. And again, so there's also a lot of misleading newspaper headlines out there that you maybe read on longevity, because a lot of it focuses on the age at time of birth. But actually what they miss is actually age, and the focus should be on age once you get to retirement. How long are you expected to live once you get to retirement? And that's because if you spend too much time on focus on the age at time of birth, which a lot of the press articles do, that underestimates life expectancy. It also doesn't take into account that life expectancy might improve over time. Again, you typically would expect life expectancy to improve. And also, and this particularly relates to retirement, is that a lot of the newspaper, they'll just focus on a single number. And actually, there's a big range round about it. And you've just cited an excellent example there. Now, that's at the extreme. I'll give you that.
Yeah, that is extreme.
But it is a great that actually we just hear an average number that maybe is a too low a number. And actually, you understand the range round about it. How big could the longevity get? And also, we also see a lot of advisors maybe default to 100. That was a thing we'd seen before. Some people say, and again, one of the risks is that you have to make sure there's actually the number of centurions has grown quite dramatically. There was something about 2020 said the number of people who were living past 100 had increased by about 50%. So a significant change there. So in terms of dealing with these misconceptions and challenging longevity, we think that, and maybe you would say this given their institutional background, we think good data is going to be the key help here. An example of this is Club Vita. So again, a longevity company we know well, part of the Hymans Group. They have longevity that goes down to street level. And it's also because it's based on defined pensioners and based on 1 in 4 of the UK defined pensioners, it's much more akin to the type of people who are probably going to come to get advice rather than just rely on sort of general whole population averages. So it's much more specific and hopefully can help overcome some of these misconceptions and also give quite a good evidence source of what longevity expectations can be, and then ultimately what that might mean for sustainable withdrawal rates. So talking about death always worries me. So hopefully I've not made it too dark.
Yeah, no, I have a different mentality about death. I think we need to start talking about it more, because it is literally the only thing that we are certain of as human people. Yeah. So there shouldn't be such a taboo in talking about it and preparing for it whenever it might happen. And I don't think it's so dark to talk about, planning for your retirement. In case you do end up living to 117, you need to have that plan in place. So yeah. And we know retirement planning goes beyond just numbers. So how does Hymans Robertson approach retirement reviews to help advisors, clients overcome some of the behavioral challenges associated with retirement?
Yeah, as you say, it goes very much beyond the numbers, Kimberley. And actually, it was at the FCA was saying retirement is one of the key drivers of vulnerability of a customer. I think alongside was it a breakup of a long-term relationship and bereavement. So it was one of the big 3 drivers there. So we look to support advisors in a number of ways. We have one way is via giving them access to tech, giving advisors access to technology, such as we've got an interactive sustainable income tool we talk about, and that that's got that evidence-based longevity information. So not only the average age, but also the range round about that. It also gives access to the projected returns. And again, in line with the regulators' needs, it's not just a single number, it's the range round about that. But the tech also allows you to put those two sets of data, the longevity and the projected returns together. And that gives you an evidence-based sustainable withdrawal rate and the range round about that can be used by advisors and across their whole firm as well to give that sort of sense. And when working with our clients, is what is a realistic sort of a sustainable withdrawal rate there. And also we like to support advisors overcome the behavioural challenges by giving regular support to any questions they get from their clients, but also writing regular and, most importantly, engaging communications which keep the clients up to date on latest markets developments, latest market events, and hopefully just reassuring them at times of stress that actually it can be wise to stay in the market for get returns. And a good example of type of comms, not that long ago, we had obviously the sell-off and related to the market volatility in early August type stuff there with the Japanese yen. It's getting an article out quickly that gets to the point that the advisors can then use with their clients just to help reassure them and stop them doing rash decisions at the wrong time. So again, it's a lot about just helping advisors hold their clients' hands and help them reel through some of the challenges with retirement using written comms, but also just technology.
Yeah. That just hitting them from all possible corners. Yeah. And now I wanted to shift focus to consumer duty. So we are now we have gone past the 1-year anniversary of it being implemented, and it did intensify the focus on value for money. So how has this impacted Hymans Robertson's approach to investment solutions and client communications? I know that you said that you make sure that you have communications and technology working together. But I wanted to expand a little bit more on that and see if you can share any specific examples of how you're ensuring value is clear and tangible for clients.
Yeah. It's been a big value for me, a big focus for Hymans ever since we launched, and I think a lot of that reflects our institutional heritage, Kimberley, where value for money has been a big focus on the institutional market for ever since I joined Hymans, but particularly the last 10 years, when it's been about making sure that you understand your fees, cost transparency, and just overall getting value for money from any service providers you use. So it's been a big thing for us. So it's not, the consumer duty has not really been a revolutionary change from that point of view. What it has meant, though, obviously, a lot more of it is documented. In particular, we, as a manufacturer of our models, we have an annual value for money policy that we share with our clients, and we also have a value for money statement that we share with our clients as well. So that's been a big thing. It's been almost like your old primary school teacher would say, shows your workings type stuff. So we'd be doing a lot anyway, but just written it down. So and we've got, so as part of that, we have it's a 17-page report we write annually, and it focuses on the key aspects of value for money. And it's really important that value for money is clearly set by the regulator, and I fully agree with this, it's not just about fees. Fees are an important part of it, and you want evidence that the fees that you've got are competitive and fair for the services you're getting. But there's also lots of other things you're getting as part of your proposition. So, for example, our value for money framework really sits across 3 bits. So it looks at fees and costs, so explicit fees, but also your transaction costs, etc. there, and make sure they're reflective. We also look at performance, making sure performance is reflective what the models are trying to do and the underlying portfolio is trying to do. But also looks at the quality of service, again, making sure that as part of the offering, you're getting these communications, you're getting the evidence that the product's doing what's expected to do, and just a general governance around it. So it's given what we've done here is give a transparency as to how we look to evidence value for money to our underlying advisors there. And that's been a big focus. But again, a lot of it comes from me on the institutional side of our institutional learnings. Have played great value here as we come to articulating this to our clients.
Yeah. And how does Hymans Robertson's investment philosophy contribute to delivering value for money under the consumer duty? And how do you articulate this connection to both advisors and their clients?
Yeah. So there are probably to answer from an investment point, it's probably worth just starting with what our beliefs are. So our core investment beliefs are that objectives and constraints, they give the context of what we're trying to achieve.
Mm-hmm.
We do believe that strategy is going to be a key driver of outcome. Evidence shows that investment strategy will drive about 90% of future outcomes. We believe that risks will be rewarded, so you want to be in the market. And we believe that costs are a tax on future returns. Those are fundamental beliefs that we have that sit across everything we do. And so what that means that for portfolios, we build what our clients need. So if costs are explicit costs are a really big feature for clients, we will put them in our what we call our markets range, our low cost models there, where there's absolutely no active in there, low cost. For people who maybe willing to a bit extra budget, we'll put them in our more blended range. It'll have a bit of active and passive and factor there. It also means our portfolios, we have big emphasis on strategy. So we're long-term investors, Kimberley. We want to be in the market. We're very low turnover. The analogy I often use is the sat nav if you're driving the car. Mm-hmm. We put the sat nav in. Yes, we're monitoring the road. Yes, we're driving the car. Yes, we'll adjust the road according to how we see the conditions. But what we're not doing is taking every B road. Mm-hmm. We just think that means the more trading you do, the more costs you do, and the more you're out the market. And that's not for us, in our view, in clients' best interest. So long-term strategic. And then we look to access markets efficiently. So for the ones with a bit of budget, we will have a targeted use of active in the areas where we think we get value for that, whether it be potential more returns or more risk management. We'll use passive where there's limited evidence that active can add value. Mm-hmm. And we'll also use alternative forms of indexation, such as factor. I think we're going to chat about factor in a bit, but we like to use factor there again. And then we also negotiate hard when it comes to managers for share classes. I'm always on the look for a deal, Kimberley. So I'm regularly annoying the managers and asking what discounts we can get on their fees. And as a whole, we've been very successful with that there. But it doesn't mean I won't stop asking for more, Kimberley. I can't help myself there. In terms of how we articulate all what we do to advisors, I mentioned the assessment of value report. Mm-hmm. And again, but we also, so as well as the advisors having access to that there, we give them that there. We do look to have regular interaction with advisors. So answering any ad hoc investment queries they've got, we'll attend the advisors' investment committee meetings that we'll minute for those as well. We do regular training, particularly on topics such as factor investing, market conditions, any developments, for example, in responsible investment. And it's all with the aim of making sure advisors understand and are getting value from our proposition. So for us, it's all about working in genuine partnership with advisors we do here to make sure we can evidence all the various attributes that we're doing and giving them value for money, but particularly working in partnership with HRIS, but also the broader Hymans Group as well.
Mm-hmm. And looking forward, so what are the pros and cons for passive investing? It may be considered the cornerstone for many, but what are the key benefits and potential pitfalls advisors should be mindful of when incorporating passive strategies for their clients? Yeah,
so passive in its purest form is it's about buying a portfolio that tracks the benchmark, mm-hmm. and in its very, very purest form, typically tracking what they call the market cap benchmark. So. Mm-hmm. And it's lots of benefits. The main one being it's very, very low cost, and it can be, particularly if it's really difficult for active managers to add value, it means you get exposure to the market at extremely low cost. And it's also low governance as well because mm-hmm. the manager has to track the benchmark. So that's good. So it's lots of advantages, there's no doubt. Some of the main challenges with it can lead to sort of concentration, where you're just following the market up. And not really thinking about is this a fair value or not, and therefore can potentially lead you into bubbles because you're just buying the market regardless of the price of a certain region there. And I think for me that's the big thing advisors need to be aware. So we think passive definitely has got to play in portfolios, but just as careful use. So remember, if you just buy a pure passive mandate, you're buying an implementation passive, but you're also you've made a benchmark decision as well if you just buy the market cap. And I think people need to think, are you comfortable with that benchmark? And a good example where that maybe sort of hurt people a bit was a lot of the bond sell-off we saw in 2022. If you just bought the broad bond benchmark, you were buying a lot of duration because you were just replicating that benchmark. And you might have wanted that duration or you might not have, but at least have a thought, do I want that duration? And it's the exact same when it comes to equity portfolios. Just because you're buying a passive market cap fund, don't think you've not made a decision on the benchmark, because you have effectively chosen the market cap benchmark, and you need to think if you're comfortable with that. So the big pros are it's cheap. The cons are it can lead you into certain areas of the market you actually might not be comfortable holding, and and it needs to be that sort of balance. But there are ways of kind of managing that, the cons part as well, because you can actually build different benchmarks, but using passive implementation that maybe avoids some of the challenges that people often associate as a con with passive.
Yeah. Would it also be fair that some people may perceive passive investing as low risk?
They might. I think it's ultimately comes down to what's your definition of risk. Often when in the traditional form of investing, in its very simplest form, you had two forms of risk. You had the asset allocation risk and the manager implementation risk. The manager implementation risk would be, would the manager do well or poorly? Well, you have removed that risk because you've now gone to a passive. So you've actually removed that second risk. You've still got the asset allocation risk. So that risk has not gone away. So for example, if you go into a passively managed equity fund, you have still got equity risk. So you've maybe got rid of the active management piece, and actually some active managers might argue that they reduce the market risk, but you've still got equity risk. So don't believe that a passive equity fund is low risk, because you're in an equity fund and that will have equity-like volatility, regardless if it's passive or actively managed. Yeah. I just thought I'd throw that in there because I think that is something that I've seen people have a misconception of passive. Yeah. So how does Hymans Robertson leverage factor investing in portfolio construction, and how do you educate advisors on the role of factors and their potential impact on client outcomes? Yeah, cool. So it's probably worth just so factor investing is something that we've used a lot across our institutional client base, and this is a bit of background. It is a sort of there's academic evidence shows that stocks have certain characteristics that persist for a period of time and ultimately get rewarded from those characteristics. So, for example, a good quality stock, something like an Apple, where earnings grow quicker than the market, over the long term, that gets rewarded for having those criteria. And also stocks maybe like something like a Pepsi, which is typically has a lower volatility of share price in the market, over time will get rewarded for having that lower volatility. And those characteristics, so that good quality or lower volatility, are just some examples of what we would call factors. Right. Now, a big industry evolution that took place about maybe 16 years ago, was that those factors previously were only able to access by way of active management. You can actually now access some of those factors by way of a benchmark index. And if you can replicate them by way of a benchmark index, you can track that benchmark and therefore get some of the features of active management, but at the cost more akin to passive. So that's what we call factor, is when it's this alternative benchmark construction. It gives us some of these greater focus on certain areas that are perceived to give us value, but they're more akin to the cost of passive, Kimberley. So that's what we call factor. So we like to use factor in our portfolio. We actually use it in both our blended range, but we also use it in our markets range. So although the markets range is low cost, we emphasize purely on index tracking, we do part of that. We have an index tracker on some of the factor benchmarks as well. So we think it's a natural complement of giving us added diversification, but still keeping costs low. So that's how we like to use factor. And again, from what we've seen based on institutional base, particularly defined contribution clients, there's been a big flow from institutional into factor, and we think we're going to see a similar trend from retail over time. And it's certainly something we're big advocates within our portfolios. And talking about the active and passive spectrum, the active versus passive debate continues. And I'm sure there's a lot of misconceptions like the ones I mentioned earlier about some people perceiving passive to be lower risk. But where does Hymans Robertson position itself on the spectrum, whether it be passive or active or in the middle? And how do you strike the right balance between these approaches to meet diverse client needs? Yeah, and it's a good question. Again, as I say, objectives and constraints for us set the big thing. So how much of a budget do you have to spend? It reminds me when I was younger, Kimberley, I used to go to the sweetie shop, and my mum, I'm getting old, my mum would only give me 10 pence or 15 pence to spend in the shop.
I feel like I was in the same generation.
And that's all I could spend. So it's a bit like when it comes to investing. If you've only got 15 basis points or 12 to 15 basis points to spend, you're just going to build something that costs you 12 to 15 basis points. And therefore that will mean you've got a tilt towards passive and factor within there. However, we do think if you've got a slightly bigger budget, you do have the ability to maybe bring some active in there. So we're actually quite happy to use active if we have the budget there, but targeted use. It's not a blanket use of active. So where we'd use active, we'd use it, we want the evidence to be on our side. So typically where we use active is where maybe on idiosyncratic asset classes, maybe some like high yield or emerging market corporate debt, where you might get some extra reward for the greater risk management you would expect from an active manager, or where we can give the manager a large universe. So maybe some targeted use of on the global equities where the manager's got a large global universe, and use that for a proportion of the mandate, but supplement it and complement it with some passive and some factor to give us that diversification. So we're comfortable using targeted use of active, but alongside sensible passive and alongside factor. And one of the questions you asked earlier, and I don't think I answered it, was part of our job with advisors is actually then doing the training as to why we've done what we've done, making sure everybody's got a role within the team there. Again, it's about one thing we use with clients often quite a lot is actually we put like a football pitch up and give the roles of the different members of the portfolio and what they're doing, if they're an attacker or a defender. And we do that with the active and passive and factor. So for us, it's about working closely with clients, educating what's in the portfolio, why it's in the portfolio, what is factor, explaining what factor is and why we like it, and also how they can then communicate that to their end clients as well, Kimberley. So again, it's just, we think there's a place for active, passive and factor, but it's subjective, what's your objective, and then the rest of the journey is about us obviously making sure we can educate and inform and support the advisors we work with.
Yeah. I have to say though, the football analogy would not work well on me. I'd be like, I don't know what any of these positions are, so explain it. Use something else potentially, or just say it. I might actually get it more that way than using football. But looking at the market currently, given the current economic climate, what specific challenges and opportunities do you see for advisors navigating retirement planning for their clients? You mentioned earlier about how the yen took a massive dip, and then that had seemed to have a knock-on effect with the US dollar as well. So no effect so far here. Are we still in the time of volatility?
Yeah, I think unfortunately, the answer to that latter question will be yes, but markets are always volatile. I think if we take a step back, outlook for projected asset returns are way more attractive than they were, say, 4 or 5 years ago. So there are lots of positive, like our long-term projected nominal returns for equities are about 8% per annum. Projected bond returns have increased dramatically from where we were. So there's lots of positives out there, but there is no doubt there's always challenges. Life's never too straightforward. Market volatility, as you correctly cite, Kimberley, is a big one. Geopolitical risks feels high at the moment. Although bonds have repriced significantly, there's still quite a lot of uncertainty about the worries about inflation, and also how governments are going to deal with the rising debts they've got, how they're going to service those debts, and is there going to be a need for, particularly within like the UK, the impact of quant tightening and the fact that institutional pension funds don't need as many of these bonds as they once did. So there's lots of things that can create headwind and create volatility. So I think the short answer to your question, I think volatility is going to be here investing. But for us, that just reiterates the point that, again, take a long-term strategic approach. We do believe you'll get rewarded for taking risk. Make sure you are well diversified, but not just between asset classes, but make sure you're well diversified within asset classes. It plays well to your question about building portfolios. So again, understand what your equity benchmark is and make sure you've got that nice diversification there, that you've avoided some of the maybe pitfalls if you just followed the market all the way up there. So again, yes, there's overall returns look better than they did from a nominal perspective. Challenges exist, but again, sensible, stay in the market, well robust, well stress tested and well diversified portfolios should help you navigate these times of volatility and help advisors navigate their clients through this sort of challenges, this sort of market volatility you might face.
And looking at the regulatory landscape, how is Hymans Robertson supporting advisors in understanding and adapting to the evolving regulatory environment, particularly in the context of consumer duty and any other duty of care things that may be brought in place? I know that the FCA are reviewing pretty much everything. So.
As somebody who's really cautious, but also a SMF, so regulated, I watch regulation a lot, Kimberley, because how it's going to impact us and how it's going to impact our team. And as you can imagine, and our clients, and you can imagine we've got a large team that sort of works on this area because it's a big part of our focus. And consumer duty, as you say, has been with us over a year now, and that's been a massive part of our focus, particularly I'd say over the last 2.5 years, is get our head around exactly what it means for us, and also equally importantly what it's going to mean for our clients as well. And a big part of our work has been making sure the clients we work with and any prospects they're crystal clear as to the role. So we are the manufacturer, and we're very crystal clear with our responsibilities as a manufacturer, and that helps the advisor position themselves as a distributor there. So again, a big part of us is giving that clarity of responsibility and also making sure we've support advisors with relative documentation. I've talked about the assessment of value, but also the relative target market wording that needs to be there as well. So just making sure we've been working closely with our clients and doing lots of training on responsibilities and giving them the evidence that they can then pass on there. But consumer duty, although over a year now, it still seems a really big focus and a big part of discussion for the advisors that we speak to. In terms of other regulation that we often see, the retirement review obviously has been quite big news for people. Again, and just reiterating that the FCA clear on a number of things. It ties in really well with consumer duty there about the need to make sure that strong evidence of approach to advice process, things about making sure portfolios have been scenario tested, make sure there's a sort of don't just rely on averages, and make sure there's that sort of consistency going all the way through firms, organisations. So that's been a big focus, and we've done quite a few sort of training sessions and seminars on the FCA retirement review, and we think that's going to continue to be a big focus for advisors over the coming months. And then the other one probably is the sustainable disclosure requirements, which fully come into play for managers from 2nd of December, and obviously has the potential of quite implications for advisors, most notably on anti-greenwashing there, but also could have broader implications for DFMs and advisors. And that's been quite a bit of work recently, but it's been a really good example where we've been able to leverage off the broader Hymans team. Given our large institutional client base, we've got a large responsible investment team. We've got a team of about 12 full-time equivalents. And certainly from me and my team, it's been great to be able to lever off them, drawing off institutional experience and helping them and helping our clients do training, understand what's needed and what the requirements associated with SDR. I think it's fair to say it's still a wee bit up in there. I think that's going to be one that's really going to take maybe hopefully get a bit more clarity over the coming months as to quite what SDR will mean for DFMs and advisors. But again, it's certainly one that's a live topic at the moment. And again, really what we do is, again, as well as doing internal discussions, but is regular ongoing interaction with the advisors and what they are seeing and really understanding what their needs are, particularly when it comes to meeting regulation, but also liaising with our clients on these sort of matters.
And earlier, you briefly touched on using technology in your to maintain kind of updated information with advisors. But I wondered, what other roles does technology play in Hymans Robertson's investment approach, and how is this leveraged to empower advisors and enhance client experiences?
Yeah, it's, as you can imagine, technology a big part. Hymans has got 1,400. Hymans Robertson as a group has got 1,400 people, and that includes over 100 in our modelling team and tech, and more, and sort of if you include digital teams there as well. So it's a big part of the Hymans proposition. Mm-hmm. Boil it down to what we offer in the retail space. Again, we use technology a few areas. So our investment process is part quantitative and part qualitative. Where the tech really adds value is the quantitative piece, because it means we can deal with big data in an efficient way. So when we're building our portfolios, we're considering over hundreds of thousands of different ways combining asset classes, and we want to identify which of those combinations are the most robust. So we combine those 100,000 potential portfolios, and we put each of those through our in-house model that models them against 5,000 economic scenarios. So each of those model against 5,000 scenarios. So you're big data there, but that's where technology and use of data management is fantastic, because that helps us there. And then obviously we do the qualitative part. Where else we use technology in terms of a role proposition? I mentioned the longevity data and the sustainable income tool. So again, it's not only helping build the portfolio tech, but it's also then helping with that interface with advisors and giving that the advisors that natural sort of interactive tooling that they can then use with their clients for showing what sustainable withdrawal rates are. Mm-hmm. So that's the big where tech is at the moment. It is just going to evolve from here. Again, a big part how I can see it, particularly when we use a lot of investment training. We have a lot of for training the advisors can then use with their clients. I think the tech's a big part how that proposition is going to evolve, and that's going to be a key focus over the short term as well. But it's a big part, not only the building portfolio, but working on this client interaction and client engagement is a big form for us. But it's just going to continue to evolve for here. Technology just continues to evolve, and I don't see any change. And if anything, it's going to speed up more than anything here.
Oh yeah, definitely. But thank you so much for speaking with me today, William. This was a really informative conversation.
Oh, well, really appreciate it, Kimberley, and lovely to meet you as well. Cool.
Thank you for listening to In Conversation With. We do hope that you enjoyed it. Please do keep up to date with all our new releases via Podbean, Apple Podcasts, Spotify, and everywhere else you get your podcasts from. You can also keep up to date with all our new content published on the Money Marketing website, as well as our print edition Money Marketing magazine. So make sure to subscribe. Follow us on Twitter, LinkedIn, Facebook, and Instagram. See you next time.